Well, we've been tracking the big breaking story at this hour and getting you a detailed analysis on India's tax treaty with Mauritius. To take you through the key salient point, 3 key salient features have been amended today. You had a significant guest outlining the pros and cons in many areas. So let's just go through them one by one. One is that with this new amended protocol, India gets taxation rights on capital gains arising from the alienation of shares, and this will be acquired on or after the 1st of April 2017. So that creates a grandfathering of about 2 years for the investments. Now, there's another very important, the second and perhaps the second most important feature of this is the limitation of benefits, that is the LOB. The benefit of about 50% reduction in tax rate during the transition period, 1st April 2017 to the 31st of March 2019, will be subject to LOB. And here, a resident of Mauritius will essentially not be entitled to benefits of 50% reduction in the tax rates. We'll take you to the exact breakup of the current tax rates and the exact impact as well. We'll try to get you more reactions on how significant this would be in creating tax clarity and in avoiding tax evasion and tax avoidance that this treaty is trying to obtain. All right, we have Pranav Sayta of EY. Thank you, Mr. Sayta, for joining in. To begin with, you've gone through the key salient features of the amended agreement. How significant would this be in creating tax clarity between the two countries? And do you believe that this creates a better case for India and Singapore to thereby amend their treaty?
I think this is an extremely far-reaching development, and it could significantly impact tax structuring going forward. Under the India-Singapore Treaty, the way it is currently worded, I think it will automatically stand impacted because of the way in which it is currently worded. So if the Mauritius Treaty changes, there will be a corresponding change impacting the Singapore Treaty as well. In a sense, any investments made up to 31st March 2017 are grandfathered, and that would mean there is actually an incentive or an inducement to invest upfront, the sooner the better, so that if a person invests before 31st March 17, his capital gains in India will always remain tax-free for all time to come in the future. And in that sense, to some extent, at the front end, in the immediate term, it can actually help because the investments made immediately or before 31st March 2017 will actually always enjoy the capital gains treaty exemption. And in that sense, I think for the immediate term, it might be actually helpful or might accelerate anyone who is wanting to make investments into India might want to make it before 31st March 2017. But overall, in the longer term, of course, investments into India will now have to factor in the fact that there will be a capital gains tax on exit. So to that extent, it's a very far-reaching development and an extremely important one.
Mr. Sayta, are you saying that investments upfront will now be easier before 2017? So are you expecting an increased inflow of upfront investments made by FSIs, FFIs or asset management companies? All right, Mr. Sayta, just hang in there. We have Shaktikanta Das, the Economic Affairs Secretary, joining in. Mr. Das, appreciate you joining in on the show. Tell me, this of course creates significant tax clarity between India and Mauritius. What is the basic move that the government is trying to obtain with this, and how significant would this be in creating tax clarity over the long term?
You see, first thing is that this has been under negotiation, under discussion with the Mauritius side for a pretty long time. And even last year also there were some discussions. We thought we had made a headway, but then, it could not be sort of concluded. So it's very heartening to note that the Revenue Department has now concluded this amendment to the DTAC with Mauritius. It, number one, it addresses the concern of the government with regard to possible round-tripping of money, possible round-tripping of unaccounted wealth from India, number one. Number two, it provides a grandfathering provision. There is a grandfathering provision for investments up to 1st April, that is up to 31st March 2017. So all investments prior to 1st April 2017 are grandfathered. So it is not as if the market or the investors are taken by surprise. Sufficient advance notice is being given. And the next point I would like to add is that thereafter for the next 2 years up to 2019, the tax will be at the rate of 50% of the normal rate.
Okay.
So therefore, it's a benign transition, a phased transition from a zero capital tax, capital gain tax regime to a normal capital gain tax regime over a period of up to 17 and thereafter 2 years. So over a period of 3 years, it's a transition. So I think the market should accept, markets should be able to absorb this. And in as much as there is a grandfathering provision, I would expect a surge of investments coming into India, especially FDI coming into India before 1st April 17.
Yeah, Mr. Das, actually FDI wasn't a big issue because people were not running away with, liquidating and claiming capital gains exemption. The problem really is for the FPI, the foreign portfolio investor. Now, here comes the first confusion from the market. Anyway, the GAR becomes applicable from April 2017. So which will prevail? Will GAR prevail or will this 50% exemption granted to investments out of Mauritius?
Now, you see, the GAR, I mean, that was the earlier version of GAR, but now in as much as there is an international treaty, I mean, this aspect will be examined when the GAR is taken up as a part of the next year's budget. So it is something I would not like to prejudge. But having said that, I would mention that naturally when there is an international convention signed between two sovereign countries and India is a signatory, naturally whatever India signs as a part of this amended DTAC, I mean, GAR will take care and take note of these amendments appropriately. Obviously, GAR cannot ignore what we have signed with Mauritius.
Okay. What about the treaty, the kind of capital gains available with companies investing from Singapore? Will that prevail or will GAR prevail? Even over there, you would assume that the sovereign agreement, the agreement between two sovereign countries will be more important than GAR, so the Singapore window will still be available?
With regard to Singapore and also Cyprus, the current double taxation avoidance agreement says that, it is linked to our renegotiation with Mauritius.
Okay.
So now that we have renegotiated with Mauritius, and we have arrived at this revised agreement, so naturally to that effect, the Singapore agreement will also get modified.
Okay. So actually the word used is coterminous. So the word used, I believe, is coterminous.
That's right, yeah.
So therefore, investments from Singapore also after April 2017 will be taxed to the extent of 50% of a normal Indian resident tax. And after 2019, investments out of Singapore will also be taxed like investments from any other country?
These things, the official clarity in these matters will be sort of issued by Revenue Department as we go by. And, the Revenue Department would be issuing official clarification. I don't want to prejudge the issue. But yes, I mean, the understanding is that whatever we agree in the case of Mauritius will be applicable in the case of Singapore also. Now, since we have renegotiated the Mauritius thing, Singapore is another sovereign country with which we have to renegotiate and bring in whatever has been done here to the India-Singapore agreement.
No, I mean, no two ways about it. This is extremely welcome certainty and extremely welcome confidence on the part of the country that we don't need tax crutches to attract investments into the country anymore. Another point of discussion or confusion in the market stems from what your predecessor told us, sir, after the budget, Mr. Adya. He was saying that no country...
He's my successor.
I'm sorry.
Yeah.
Okay. Yeah. He was saying that anyway, no country offers complete long-term capital gains exemption for portfolio investments. And therefore, a long-term capital gains tax is on the way. That was very much a discussion during the budget and before the budget. So should we assume that all this clarity and certainty is paving the way for probably an imposition of long-term capital gains tax next year?
No, I can't prejudge that. It's a tax matter which will come as a part of the budget. I cannot say that, which tax will come in the next budget.
I agree. But philosophically and in principle...
But having said that, let me add that the amended protocol now creates a level playing field between domestic investors and the investors who had an unfair advantage when they
Fair
came
enough.
to the Mauritius route.
Yes.
So now there is a level playing field. Number one, I would like to mention. And number two, even for FPI, I mean, you mentioned earlier that we are talking of FPI and not FDI. Now, even in the case of FPI, let me say that Indian market today, Indian markets are offering very good return comparable to what investors would get in other jurisdictions.
Absolutely.
So therefore, the flow of investment will definitely continue into India. After all, how many countries are there today which record a 7% plus growth and which offer the kind of decent return which Indian markets are offering?
Oh, absolutely. And with a stable currency. So even the currency has not eaten away benefits like they would have eaten
Absolutely.
in the other
You're right.
BRICS countries. I
Absolutely,
take your point completely, sir. Now, therefore, should we assume that P notes as a product dies after April 2019 at least?
I think you have to have patience. All these things we will issue clarity as we, go by. We will have to be a little patient. But this is, something for which I must say that I would compliment my ex-colleagues in the revenue department for having taken it forward and having concluded it. And this not only brings in tax clarity, it, sort of that suspense which was continuing off and on, it gives clarity. And then it's a benign and a very smooth transition
Absolutely.
into a regime whereby we will have the full taxation, because there's a 1 year window from now to April, and again thereafter another 2 years. Where 50% will be, 50% of the tax will be levied.
No quarrel at all.
It's a very phased and benign process of transition, and I think investors, I would expect investors to take a very reasoned view of the whole matter, and in fact, I would feel that there would be a surge in inflow of investment.
Yeah, I mean, full marks as far as predictability and the equity that underlies this amendment, sir. But now from the point of view of someone who's so close to the exchequer, will this mean a lower flow of amounts or higher flow of amounts? Because you have a larger universe to tax.
Naturally.
I mean, more tax, more money in the kitty?
Yeah, naturally, but that will come only after 1st April 17.
Yes.
No?
Yes.
That will come only at a future date. So for the next financial year, 17-18, we will have the benefit of this additional revenue into the government kitty.
Yes. And after 19, even more.
Naturally, yeah.
All right. Mr. Das, it was a pleasure speaking with you. Thank you very much for joining in and clarifying the other confusing issues with respect to the investments from Singapore and the longer term nature of the amendments that were brought in today. Thank you very much for joining us.